terms of how I look to help an individual, I tend to have a sort of an overall view of trading that I'm looking to make sure that the individual has covered. And I talk about that as being the kind of the four M's of trading. So that's about markets, it's about method, it's about money, and it's about myself. Okay, and it's those four areas where we'll look at an overall sort of holistic approach as to what an individual is doing in the market. Okay, so what I'll do is I'll talk through and I'll explain each of those four sections in a little bit more depth, and then hopefully that will provide some insight into A, the way I work, and B, also you should be able to get a little bit of feedback on maybe areas that you are strong in and areas that you may be weak in, and there might be areas that you've not even considered, and so hopefully that would help raise your awareness so that you're able to make better choices, and because once you make better choices you tend to get better results. What I sort of try to explain the kind of the four M's in a little bit more depth. Let's take two traders. We'll take a trader Paul, and then we'll take trader John. So trader Paul, he's in kind of good financial, mental, emotional and physical health. He has support structures around him that help him. So in terms of his family are supportive, his friends are supportive, his work may be supportive if he's trading around around a day job. So he's managing himself. He's managing myself in a good way. In terms of the managing money, okay, the individual Paul he's managing risk in every trade. Okay, he never trades without a stop loss, and he never trades or risks more than a small portion of his account on any one trade. He is managing the money. Okay. In terms of the way he actually engages with the market, well, he's actually trading a style, a method that actually suits his personality and his lifestyle. It might be that trader Paul is a trend following trader that just waits for opportunities to jump on board a trend and then just basically ride those trends until the end. It works and it suits his personality and his kind of trader profile. So he's managing the method. And then finally, as he knows that his method is based around trend following, so he's always looking for markets that are actually in a trend following environment. When markets are in a consolidating environment, he leaves them alone. So basically he has his markets, his method, his money and himself. They are all in alignment. And when those four areas are all aligned, you tend to get a little sweet spot, and that's what actually helps deliver the kind of profitable results that an individual's looking for. So let's take the second trader. So trader John. Well, trader John he's in poor physical, mental and emotional health. His partner and his family don't like the fact that he's engaging in financial markets. He has no other success or support structures around there to help him. He's engaged in a lonesome endeavour. In terms of his managing money, okay, well actually he has a very, very poor risk management profile and strategy, and he struggles to actually keep it. He struggles to actually manage risk and respect his stop losses within his markets. In terms of his trading, his method, well, he bought a cheap ebook off the internet that provided him and offered him the chance to a holy grail of secret trading strategies that were going to unlock unlimited wealth from the financial markets. The method has no background in terms of being suitable for his personality, and so he finds it very, very hard to actually follow that method when it actually has its inevitable drawdowns. And well, finally, for his markets, he's not really trading the markets that are suitable either A, for his personality, or B, for the kind of method that he's trying to engage with the market. So he's completely out of sync. He's out of sync in his markets, his method is out of sync with his own profile, his money management is dangerous, and in terms of managing myself, in terms of managing himself, that's very, very poor. So we had trader Paul, who's doing all of those things well, trader John is doing all of those things poorly. If you had to think about, well, which of those traders is more likely to be a success as a trader, it's more likely that it's going to be trader Paul than trader John. And it's about being able to help an individual actually recognize where and how are they managing those four M's of trading in their own life. Are they presently a strength? Are they presently an area that needs development, or is it an area that they've not even considered in terms of the way they approach and engage with financial markets? So let's look at the sort of the first of those M's. Let's look at markets. It's the simplest one. So an individual has a vast array of markets that can be traded these days. Okay, from equities, individual shares, from the actual indices, the equity indices. You can trade the sort of commodities markets. The hards and the softs. You can trade the foreign exchange markets, and you can even trade the bond market. So in terms of array of instruments that are there, that these days, for the private trader, it's a limitless array of instruments that an individual can trade. And sometimes that is helpful, other times not so much. Okay, sometimes you can have too many options. Okay, and it's about understanding the individual. Are they really trading the right market for themselves, but also for their particular lifestyle? Okay, so an individual who can only trade a couple of hours in the evening. Okay. Let's say during the sort of European working day, and can only trade, say, between 7 and 9 p.m. in the evenings. Trading something like the FX pair, the euro against the pound, is probably not a wise choice to make, because during that period, at 7 till 9 in the evening, the vast majority of the players in that market, the Europeans and the British traders, they're all firmly tucked up in their bed or in the bar, depending upon their own proclivities. And so it's about working out, am I trading the right market for my particular lifestyle? And when you look at markets, you could talk them in very, very complex, abstract terms, but realistically, for a private trader, you just really want to understand, is that market I'm trading, is it trending or is it consolidating? Okay, there are many, many ways you can find out how to define whether a market's trending or consolidating, but it's not that difficult. Okay, if you look at a chart, a good trend should leap off the page at you, and if it isn't, if the market's looking messy, if the market's looking as if it's just bouncing between regions, then that market is consolidating. Okay, so just know what phase your market is in. Is it trending or is it consolidating? Once you get that idea, then you can actually start to work down and develop the right methods for the right market environment. So let's look at the second of those 4 M's of trading. We'll talk about is the method of trading. Okay, this is it's normally the area that has the most popular focus. Okay, people love talking about strategies. Okay, they love talking about tactics. Okay, if you go on the internet and Google for methods and strategies and tactics, you'll find thousands and thousands out there. They love it. They love to know, where am I going to buy, where am I going to sell, where am I going to get out when I make profit. That's what most of the amateurs are thinking about. Okay, people always want to know how the other person actually trades. Okay, if they meet another trader, well, how do you trade? Well, how do you get in? How do you get out? People love it. It's the most popular focus. But actually, as you go on, in some respects of those 4 M's, it could actually be said that it's in some respects it's the least important. Okay, the actual method of where you buy and where you get out. Okay, people love entries, but actually it's normally the exits that are more important. Where am I going to get out if I'm wrong? Where am I going to get out if the market goes in my direction? Okay. So, but when they look at the methods, it's also once again important to know what type of method are you using. Okay, what type of way are you analysing the market. Okay, some people will use fundamental analysis. Okay, so they're actually looking into either sort of the government news announcements, or they're looking into the individual balance sheets and statements from a company. Some people will be using technical analysis, looking at sort of price action on a chart to make their decisions. Some people might even use a version of sentiment analysis, working out the kind of whether it's sort of the kind of levels of fear and greed within the market, and understanding the kind of the strength and weaknesses within the market. They're all different types of analysis. They all have their pros and cons, but once again, it's about the individual working out which is the way that best suits their style of trading. And then when people start to look a little bit more at individual kind of methods, we're looking at there's not that many different styles. Okay, there'll be some people who like trend following, there'll be some people who like trading ranges when markets are consolidating, there'll be some people who will trade versions of arbitrage, actually trading one market off against another or one platform off against another, and there'll be some people who'll be trading trying to trade event-driven events. Okay, so maybe they'll be sort of through news announcements, and they'll actually be looking to trade around those. I suppose the thing what I've found is that realistically, when you look at all these different types of methods, everything works and nothing works. Okay, it's all about the right context. Okay, trading the right method for the right individual in the right instrument in the right market phase. Okay, and once you get those starting to come together, your ability to deliver profitable results increases exponentially. The third part of the third of the 4M's, what we talk about, is money. Okay, and I would suggest that for most private traders, certainly most private traders who've maybe having a little bit of a struggle recently, I would suggest that this is the area for the most necessary focus. Okay, this managing risk is key, first and foremost. Okay, you always need to manage the money. Okay, that's if you take nothing else away, that's what you take. Okay, money management, managing risk, that comes first. Okay. So with regards to private traders, one of the big challenges we have is realistically talking about capitalization. Okay, now it's about understanding, is an individual properly and adequately capitalized to achieve the goals they may have set themselves. Sometimes people they're undercapitalized, but their goals are just they're just overreaching. They're almost setting themselves up for failure. Okay, and actually it's about sort of managing those expectations once again, and starting to sort of find a way that the individual can actually work positively and work with confidence and self-belief rather than setting themselves up for failure. Once we've sort of understood about capitalization, then we're getting into really the sort of the details of ensuring that an individual understands about the sort of managing, let's say, profile risk in terms of the overall individual's risk profile. We all have our own individual sort of risk profile, and we have to be able to understand and work that out. Then we're looking at, is that person managing portfolio risk? Okay, are they actually do they just have too much of their account at risk because their portfolio is far too big? And then we're looking at, now we need to look at, the actual managing risk on an individual trade. And that's about an individual understanding position sizing, trade sizing, recognizing that the two very, very simple rules: you never ever trade without a stop loss, and you never trade or never risk more than a small portion of your account on any one individual trade. You do those two things, okay? Yes, you'll make mistakes. Yes, you'll have losing trades. But the important thing is you'll be able to come back to fight another day. You'll be able to learn from those mistakes. And once you've got all that kind of those risk management sort of elements in place, for some people, it's about ensuring that they're sticking with it, okay? Ensuring that they are sticking with those kind of money management rules and guidelines. Very often when people fail to stick with them, it's because they're still struggling with their expectation management. They still may be undercapitalized, or it might be that they're struggling with areas outside of trading, and that's one of the things we'll cover in the fourth part, which is about myself. So the fourth and final M of trading is about myself. All right. Very often for private traders, this is the area that is most often ignored. Okay, the reason being that they don't realize the impact that trading can have upon their psychology, or rather the impact their psychology can have upon their trading. They think that they trade in a bubble, okay, that whatever happens within the other areas of their life has absolutely no impact upon their trading. And unfortunately that's just not the case. Okay, we don't trade in a bubble. We don't really do anything in a bubble. We're always impacted by the other events and environments within which we find ourselves. So with regards to sort of managing myself, there's an element about managing physical health, financial health, mental health, emotional health. Some might even say the spiritual health. Okay, in terms of physical health, that doesn't necessarily mean you need to be sort of an Ironman triathlete. Okay, but you certainly need to be looking after yourself and keeping yourself in good order. It'll help to manage those stressful periods, because I assure you there will be stressful periods. Furthermore, you need to have your sort of your mental health in a good space. Okay, mental health is about the let's say the kind of the images and the visions that you hold within yourself in terms of your self-image and your self-esteem. Okay, if you are if you are not in a good space there, I can assure you that the market will show that up to you. The market is just a mirror and will reflect anything back at you. Then we're looking at really your emotional health. Okay, your emotional health might be that about how you're feeling about yourself and about your trading. Now, what you'll find is that there'll be lots of people out there talking about how traders need to have sort of their blood needs to be ice cold in their veins. Okay, they need to be an absolute iceman. The truth is very different. Okay, we all are emotional beings. And it's about being able to manage those emotions. Okay, it's about being able to recognize that you might be feeling bad about a trade, you might even be feeling a little bit bad about yourself, but it's about recognizing that you are not those. You are not those emotions. It's about being able to manage those and having the right structures to help you with that. Then, in terms of another term of health, is maybe your financial health. Okay, what do I mean by that? Well, if you're trading because let's say you need to make money to make the rent check, or you need to make money to pay bills, that means you're coming to the markets with a need to trade for money rather than a need to trade for opportunity. And those are two very different spaces to actually come from. If you're trading with scared money, you'll find it immensely difficult to actually achieve the kind of results you're looking for. And then finally, spiritual health. Okay, that doesn't necessarily mean religion, but that just might be, your own, how good you feel in yourself in terms of your own understanding of your own spiritual being, and everybody has their own view on that. Looking at that, in greater depth over all of those, certainly what I have found has helped the vast majority of individuals is about recognizing that any top performer in any kind of sort of industry or any kind of endeavor, that they tend to have support structures or success structures built around them. Okay. You look at, say, Lewis Hamilton. He's a Formula One driver. Okay, Lewis Hamilton had a mental conditioning coach from the age of 16 when he joined McLaren. Okay, you look at top sports people; they have all sorts of manner of conditioning coaches around them. You look at top ballerinas. Okay, they all have mentors and coaches around them. Okay, and top traders you'll find will have really good support structures around them. That can be professional structures in terms of coaches and mentors to help them, but it can also be informal support structures. It might just well be that 2 or 3 other buddy traders who you can chat to during the day. Maybe you meet up every so often, have a dinner and a beer and just chat about your trading. Okay, and it might well just be that you have sort of, let's say, formal family structures in terms of your partner is on board with what you're actually doing and help support you. Your family and your close friends are there to actually help provide you with that support. I really think that trading as a private trader can be quite a lonesome endeavor, and it's important to build in social elements to your lifestyle. We are all social beings, and so building those kind of support structures around an individual is immensely important. And as I said, very often these elements I've just spoken about, most people ignore them or are not even aware of the impact that it has on it until it's too late. And what I try to do is to help people down that path recognize that they need these structures in their life and start to put them in place to help put them in a good space to trade well going forward.